There are three words that will make your bank waive a fee on the spot. Any fee, any amount, any institution. And the overwhelming majority of seniors who are paying monthly charges on their bank accounts have never once said them. Not because the words are complicated, not because they require any special qualification, but because nobody ever told them these words existed. And banks have every financial incentive to make absolutely certain that situation never changes. The average senior over 65 pays between $180 and $420 per year in bank fees that are either legally waivable, contractually prohibited, or reversible on request when you use the right language. That money comes directly out of Social Security deposits, pension checks, and retirement savings, quietly, automatically, every single month. While the bank's automated system counts on the fact that most account holders will never question a single line item on their statement. This video gives you the three words, the exact sentences to build around them, and the specific legal context that makes those sentences impossible for a bank to ignore. By the end of this video, you will have everything you need to recover what was already taken and to stop every improper charge going forward. If this is your first time on this channel, subscribe right now. Professor Kyle Pomerleau publishes new videos every single week covering the banking rules, tax laws, and government programs that put real money back into the pockets of seniors and retirees. Free. Plain English. Nothing to sell. Hit subscribe and tap the bell so you never miss one. Before going any further, I need to speak directly to two groups of people who are already feeling skeptical, because both of them are about to miss something genuinely important. The first group is the senior who has already tried calling their bank about a fee and was told the charge is valid and non-refundable. They are sitting there thinking that if the bank already said no, there is simply nothing left to do. That experience is extremely common. It is also the direct result of calling without the right language. A customer service representative fielding a general complaint about a fee has a script that leads straight to denial. A customer service representative who hears a specific legal term referenced in a specific context has a completely different script. One that leads to a supervisor, a compliance review, and in the majority of cases, a full refund. The three words I am giving you today are not a polite request. They are a legal citation trigger. The response is different because the entire conversation becomes different. The second group is the senior who banks at a large national institution and believes their bank is simply too big and too well regulated to be charging fees that can be waived with three words. That confidence is misplaced in both directions. Large national banks charge more improper fees than smaller institutions, precisely because their systems are more heavily automated and their fee revenue is substantially larger. And large national banks are actually more responsive to legal language, not less, because they maintain compliance departments whose entire function is avoiding regulatory action. Mentioning a federal statute to a compliance-aware institution produces a faster response than mentioning it to a smaller community bank that has never undergone a CFPB audit. I am going to give you the three words, show you exactly how to deploy them across 6 specific fee categories, and tell you precisely what to do when the bank says no the first time. Why can 3 words waive a bank fee? The mechanism behind this is automation combined with asymmetric information. Your bank's fee system does not evaluate whether a specific charge is appropriate for your specific account. It applies a fee schedule to every account within a category and processes the revenue automatically. Nobody reviewed your individual file and decided to charge you. The system charged everyone and operates on the assumption that most people will never know which charges are waivable and which are not. The asymmetry is the critical factor. Your bank employs compliance attorneys, regulatory specialists, and customer service representatives trained specifically to handle fee disputes. You receive a one-line charge on a monthly statement. That information gap between what the bank knows about your rights and what it actually tells you is precisely where the fee revenue lives. The Consumer Financial Protection Bureau has issued enforcement actions totaling billions of dollars against major banks for exactly this practice. The banks paid the fines. The automated fee systems kept running. The only thing that changes the individual outcome is the individual account holder knowing enough to invoke their rights directly. The three words close that information gap. They signal to everyone on the bank side of the conversation that you understand the legal framework and that the bank's liability exposure just shifted. You are no longer simply a customer complaining about a charge. You are a potential regulatory exposure. My name is Professor Kyle Pomerleau. I have spent decades studying federal consumer protection law and the specific gap between what banks are legally permitted to charge and what they actually charge when they believe account holders will not push back. The situation I find most genuinely frustrating is not the senior who is defrauded in an obvious scheme. It is the senior who has been a loyal customer at the same institution for 20 or 30 years, who trusts their bank completely, and who has been paying charges every single month that their own account agreement either prohibits or makes waivables up simply because no one ever provided them with the language to challenge it. I have watched seniors recover 6 months of monthly maintenance fees in a 4-minute phone call. I have watched a single sentence cause a bank to reverse an overdraft fee that a customer service representative had previously called non-refundable. The difference in every single case was not the situation, it was the language. That language is exactly what this video delivers. Here is what we are covering. I am going to give you the 3 words immediately so you have them before anything else. Then I will show you exactly how to use them across 6 specific fee categories: monthly maintenance fees, overdraft fees, paper statement fees, minimum balance fees, wire transfer fees, and account closure fees. For each one, I will give you the complete sentence to say, the legal basis supporting it, and what to do when the bank's first response is no. Then I will add 2 bonus points covering the written escalation process and the CFPB complaint that makes banks move when phone calls alone cannot. The 3 words regulation, violation. Those are the words. 2 single words and 1 letter followed by a word. They are not complicated. They are not aggressive. They are a federal regulatory citation. And the moment a bank employee hears them in the context of a fee dispute, the conversation shifts from customer service directly to compliance. Here is why. Regulation E is the federal regulation implementing the Electronic Fund Transfer Act. It governs electronic transactions, direct deposits, debit card purchases, ATM withdrawals, and every fee associated with all of them. It requires that fees be disclosed before they are charged, that consumers receive advance notice of fee changes, and that certain fees be waived under specific conditions. When you say Regulation E violation during a fee dispute, you are simultaneously communicating 3 things to the bank. You know the federal law governing this transaction, you believe the fee violates that law, and you are aware that CFPB enforcement authority exists to pursue that violation if the bank does not address it internally. That combination, specific statute, specific violation allegation, implied regulatory consequence, is precisely what changes the bank's response entirely. Fee Category 1, monthly maintenance fee. The complete sentence. I am disputing this monthly maintenance fee as a potential Regulation E violation. My account receives qualifying direct deposits that meet the waiver condition in my account agreement. I am requesting a refund of all monthly maintenance fees charged during the period my direct deposit was active. The legal basis. Regulation E requires that all fees associated with electronic fund transfers, including direct deposit accounts, be disclosed accurately and applied consistently with the account agreement. If your account agreement lists direct deposit as a fee waiver condition, and you have been charged the fee while your direct deposit was active, the charge is inconsistent with your disclosed account terms. The bank's own agreement becomes the legal foundation for the refund. Dual group delivery. For the lower income senior whose primary deposit is Social Security, your Social Security direct deposit is a qualifying electronic fund transfer under Regulation E. If your account agreement lists direct deposit as a monthly maintenance fee waiver condition, and virtually every major bank's agreement does the end, then every month you received your Social Security deposit and were still charged. The fee represents a month of recoverable charges. The standard recovery window is 24 months. For the more comfortable retiree carrying higher balances, Your waiver condition is more likely the minimum balance provision than the direct deposit provision. The sentence works identically. Simply substitute the minimum balance waiver language in place of the direct deposit reference. If the bank says no, ask to be transferred to the compliance department, not a supervisor within customer service. Repeat the sentence to the compliance representative. Record the name of every person you speak with along with the date and time of each call. This documentation forms the basis for written escalation if needed. One action right now: pull your account agreement from your bank's website. Search the document for the words monthly maintenance fee and read every sentence in that section. Identify every waiver condition listed. Verify whether your account currently meets any of them. If it does and you have been charged the fee regardless, call your bank today and use the sentence above. Fee Category 2: Overdraft fee on a debit transaction. The complete sentence: I am disputing this overdraft fee as a Regulation E violation. Under Regulation E, overdraft fees on debit card transactions require affirmative opt-in consent. I have no record of signing an opt-in form for debit overdraft coverage. I am requesting documentation of my opt-in and a full refund of all debit overdraft fees charged without confirmed opt-in consent. The legal basis, Regulation E, Section 1005.17, specifically prohibits financial institutions from charging overdraft fees on ATM and one-time debit card transactions unless the consumer has affirmatively opted into overdraft coverage for those transaction types. The opt-in must be documented in writing. If the bank cannot produce a signed opt-in form, every overdraft fee charged on a debit transaction is a Regulation E violation. Dual group delivery. For the lower income senior living on a fixed monthly income, overdraft fees hit fixed income accounts disproportionately because deposit timing creates brief gaps before the next Social Security or pension payment arrives. If you have paid overdraft fees on debit purchases without ever signing an opt-in form, every single one of those fees is recoverable. The bank must either produce the signed opt-in or issue the refund. For the more comfortable retiree tie, your overdraft fee exposure is typically lower, but the legal principle applies equally. More importantly, if you hold accounts at institutions that have not updated their fee schedules to reflect the 2024 CFPB guidance capping overdraft fees at $8, any overdraft fee above that amount is independently subject to a full refund demand. If the bank says no, request the specific document, the signed opt-in form, in writing. Ask for it by mail or email. A bank that cannot produce that document within 10 business days effectively has no legal basis for the charge and almost always issues the refund rather than continue extending the paper trail. One action. Right now, call your bank and ask this specific question. Do you have a signed Regulation E overdraft opt-in form on file for my account covering debit card transactions? Write down the answer and the name of the person who provided it. Fee Category 3: Paper Statement. Fee. The complete sentence: I am disputing this paper statement fee as a potential Regulation E and Truth in Savings Act violation. I did not receive compliant advance notice before this fee was introduced. I am requesting documentation of the advance notice provided and a refund of all paper statement fees charged without my acknowledgement of the fee change. The legal basis. The Truth in Savings Act requires advance written notice before any new fee is introduced on an existing deposit account. That notice must be clear, conspicuous, and provided with sufficient time for the consumer to respond, typically 30 days. A fee introduced through a notice buried inside a paper statement, embedded within a terms and conditions document, not separately highlighted, or provided without any acknowledgement from the account holder, does not meet the required disclosure standard. Dual group delivery. For the lower income senior who depends on paper statements, you are entitled to receive a paper statement. You are not required to pay for it unless you affirmatively agreed to a fee schedule that included it with proper advance notice. The paper statement fee is both the most easily challenged and the most commonly charged without compliant disclosure. For the comfortable retiree maintaining multiple accounts, the paper statement fee appears small per account, but multiplies across institutions in years. A systematic review of paper statement fees across all accounts frequently reveals 2 to 3 years of improperly charged fees, recoverable with a single call per institution. If the bank says no, ask for the specific date the advance notice was sent, the delivery method used, and confirmation that it was sent separately from the monthly statement. Banks that introduce this fee through statement inserts rarely maintain documentation of separate advance notice. The absence of that documentation is the legal foundation for the refund. One action right now. Review your last 24 months of bank statements for any line item labeled paper statement fee, statement delivery fee, or anything similar. Total the amount charged. Then call your bank and use the sentence above. Fee Category 4. Minimum balance. Fee with direct deposit active. The complete sentence. I am disputing this minimum balance fee as inconsistent with my account agreement. My account receives qualifying direct deposits that trigger the fee waiver condition in my account agreement. I am requesting a refund of all minimum balance fees charged during the period my direct deposit was active, which I believe constitutes a Regulation E disclosure violation. The legal basis. If your account agreement provides that direct deposit of a qualifying amount waives the minimum balance fee, and most agreements do, then charging the minimum balance fee while your direct deposit is active represents a fee charged in violation of the account's own disclosed terms. The Regulation E reference applies because the direct deposit itself is an electronic fund transfer governed by Regulation E, and fees inconsistent with disclosed terms on Regulation E accounts fall squarely within the CFPB's enforcement jurisdiction. Dual group delivery. For the lower income senior WASC, this is the fee most directly targeting fixed income account profiles and most clearly prohibited by standard account agreement terms. The resolution requires a single phone call referencing the direct deposit waiver condition in your agreement. For the comfortable retiree, if your balance regularly exceeds the minimum balance threshold, this fee simply should not be appearing. If it has been charged regardless, the account agreement discrepancy is the basis for the refund independent of any Regulation E framing. If the bank says no, request a written explanation of why the direct deposit waiver condition was not applied to your account during the period in question. A written explanation creates a documented paper trail and typically triggers an internal review that produces the refund. The phone call failed to deliver. One action. Right now, log into your bank account online and review the fee section of your account agreement. Locate the minimum balance fee waiver conditions. If direct deposit is listed and your Social Security or pension payment deposits directly to that account, you likely have recoverable charges going back 24 months. Fee Category 5. Wire transfer fee above the disclosed amount. The complete sentence. I am disputing this wire transfer fee as a Regulation E violation. Under the Electronic Fund Transfer Act, fees associated with electronic transfers must be disclosed before the transfer is initiated. The fee charged exceeds the amount disclosed in your published fee schedule. I am requesting a refund of the difference between the disclosed fee and the amount actually charged. The legal basis, Regulation E and the Electronic Fund Transfer Act, require that any fee associated with an electronic funds transfer be disclosed to the consumer before the transfer is initiated. A fee charged above the published schedule is a fee the consumer never agreed to, and therefore a fee collected without valid contractual or regulatory basis. Dual group delivery. Both groups equally. The wire transfer fee discrepancy is the most straightforward fee dispute because the evidence is entirely numerical. The published fee schedule is available on your bank's website. The charged fee appears on your statement. If the numbers differ, the difference is recoverable with a single reference to Regulation E and the Electronic Fund Transfer Act disclosure requirement. If the bank says no, request the fee schedule that was in effect on the exact date of the transfer. If the bank cannot produce a schedule showing the higher amount was the disclosed rate on that specific date, the refund is legally required. One action. Right now, pull your last 12 months of bank statements and identify every wire transfer fee charged. Go to your bank's website and locate the current wire transfer fee schedule. Compare every charged fee against the published schedule. Any discrepancy is recoverable. Fee Category 6, Account Closure Fee. The complete sentence, I am disputing this account closure fee as a potential Regulation E and Truth in Savings Act violation. This fee was not disclosed at account opening, and I did not receive compliant advance notice before it was introduced. I am requesting a full refund of this fee and documentation of the original disclosure. The legal basis. Under the Truth in Savings Act, an account closure fee must be disclosed at account opening. If it was absent from the original fee schedule or added after account opening without compliant advance notice, the bank has no contractual basis to collect it. Account closure fees introduced through statement inserts without separate notification consistently fail the legal disclosure standard. Dual group. Delivery, both groups. Account closure fees are charged at the moment of maximum customer vulnerability, when you are leaving the institution and least likely to spend time disputing a final charge. That timing is entirely deliberate. The sentence above is most effective when delivered before the account is fully closed. Call the bank before the closure is processed and dispute the fee as a condition of completing the closure. If the bank says no, request a copy of the original account agreement showing the closure fee was disclosed at account opening. If the fee was added after opening, request documentation of the advance notice provided. Either request typically produces the refund faster than any further verbal argument. One action. Right now. If you are planning to close any bank account, call first and ask whether a closure fee applies. If yes, ask for the section of your original account agreement disclosing that specific fee. If they cannot cite it, use the sentence above before the account is closed. What to do when the bank says no. Everything covered above gives you the 3 words in the complete sentence for 6 specific fee categories, addressing the vast majority of improper charges appearing on senior bank accounts. What follows is specifically for the senior whose bank said no, the first time and for whom the dollar amount in dispute is significant enough to pursue through formal channels. Bonus 1. The written escalation letter. Banks cannot ignore. A phone call to customer service creates no record the bank is legally required to respond to. A written letter to the bank's compliance department creates a documented regulatory record the bank must acknowledge and address within a specific time frame under federal consumer protection law. The written escalation letter should contain 4 elements. First, a description of the fee disputed, the date it was charged, and the total amount. Second, the specific legal basis for the dispute, Regulation E, the Truth in Savings Act, or both cited by name. Third, the response received from customer service and the name of the representative who provided it. Fourth, a specific demand, reverse the charge within 15 business days or provide written documentation of the legal basis for the fee. Send the letter by certified mail to the bank's compliance department, not the branch location, not the general customer service mailing address. The compliance department address is available on the bank's website under its regulatory filings, or by calling the main number and specifically requesting it. A certified letter to a compliance department referencing Regulation E by name produces a substantive response in virtually every case where a phone call alone did not. Bonus 2, the CFPB complaint that costs the bank more than the fee. If the written escalation letter does not produce a resolution within 15 business days, the next step is filing a formal complaint with the Consumer Financial Protection Bureau at consumerfinance.gov. When a consumer files a CFPB complaint, the institution is required to respond within 15 days and provide a substantive resolution within 60 days. The complaint and the response are logged in a public database the CFPB publishes, directly affecting the institution's regulatory examination record. Banks receiving CFPB complaints about the same fee category from multiple consumers trigger a pattern examination, the kind that results in the billion-dollar enforcement actions that have made headlines. The practical outcome for an individual senior is straightforward: a fee that customer service called non-refundable and that a compliance letter failed to reverse almost always results in a full refund within 30 days of a CFPB complaint being filed. Because the cost of a single refund is far lower than the cost of a regulatory record, showing the bank ignored a consumer protection complaint about a fee category the CFPB has already taken enforcement action on at other institutions. The one idea that makes these three words so powerful: banks charge improper fees because the entire system assumes you will not know your rights. The moment you demonstrate that you do, by citing a specific federal regulation by name in the context of a specific fee dispute, the bank's calculation changes completely. You are no longer a customer who might complain. You are a potential regulatory exposure. That is precisely what Regulation E violation means to a compliance-aware institution. It signals that the conversation has moved from customer service to legal risk. The 6 fee categories covered today: monthly maintenance, overdraft, paper statement, minimum balance, wire transfer, and account closure, represent the most common improper charges appearing on senior accounts across every type of institution in this country. The three words work across all 6 because they invoke the same federal framework governing every single one of them. You do not need a different argument for each fee. You need the same 3 words delivered with a specific sentence connecting them directly to your situation. Professor Kyle Pomerleau's message on this channel never changes. The law gives you far more protection than the institutions collecting money from you want you to realize. The gap between your legal rights and what you are actually receiving is closed by knowledge, specifically by knowing which words to say to whom and in what context. You now have that knowledge. Use it before the end of this month. Before you close this video, do one thing. Send it to one person in your life who is over 65 and has a bank account: a parent, a neighbor, a friend from church. It does not matter whether they bank at a national institution or a local credit union. Every single fee category covered today appears on accounts at institutions of every size across the entire country. The person you are thinking of right now is almost certainly paying at least one of these fees every single month. One phone call informed by this video, 3 words and 1 sentence, could recover hundreds of dollars for someone you genuinely care about. That is worth more than almost anything else you could do for them today. That is exactly what this channel is here to accomplish. In the next video, I am going to show you the SSA back payment that most seniors never request, money the Social Security Administration is legally holding for you, that does not appear on any statement, and that the SSA has no obligation to mention unless you ask precisely the right question. I will see you there.